stopping you from financially forward thinking. Let's go. Yeah. Wake up, check the bank account. Watch the numbers running out. Send the check to someone new. Generous is what I do. Walking down the leasing street. Cycle that I just repeat. Money rushing left and right. Gone before the end of night. Don't know the roof, don't know the
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
It's impressively rap, but it's still a trap. Forward thinking, not too late. Tendency is here to stay. Generous contributions flow, helping them.
All right. I mean, for those of you who are perpetuating yourselves in tendency, just making those generous contributions on a monthly basis. Help me understand now, this 2026, what is stopping you from financially forward thinking as we bring our special guest in studio this evening?
Hi,
okay.
William. How are you?
Doing good and better than most, I would assume. What about you? How are you doing?
Very good. It's been a wonderful couple of days of summer, and I'm so glad it's here.
I know, I can tell, because I mean, I've been pursuing you. I've been running behind you a couple of times, calling you and not getting you. So I knew that you were busy out there.
My dad has been a little bit ill, but that's okay. That works itself out. And Memorial Weekend, I try to take a couple of days off. So I appreciate that I'm back again. And last night I was so tired, I fell asleep, and I'm so tired. But I'm here today, and we're going to talk about what home lenders look at besides your credit score. Beyond your credit score, what do they need to see?
Definitely. What home lenders look at beyond what? Your credit score. I mean, help us understand. But welcome back to the podcast. Today we'll be talking about something a lot of people worry about when they start thinking about buying a home. Credit score. It's
right?
really
Credit score is one of the strengths, but it also takes income. It takes money. It takes down payment. It takes all of those things combined together. You can't have just a good credit score without an income. Doesn't get you into the house. So we're going to talk about what we look at behind your credit score.
It really is. I mean, a lot of people think, if my credit score isn't perfect, I'm done. But today, thankfully and hopefully, you are here to tell us about what home lenders actually look at beyond what? Just the credit score.
Right.
So if someone feels nervous about that one number, this conversation should help them to understand the bigger picture.
If we can get a good credit score showing that you're strong on all of your accounts, other than maybe you had one. I had one recently where a young man co-signed for his mother, although he was the only signer on the documents we saw, for his mom to buy a mobile home several years ago. And when I say several, I mean 3.5 years ago. And they foreclosed on it. And despite that, they did not request that we pay the foreclosure off. They let the foreclosure go or the repossession go, and he was able to buy a home. We didn't have to count it, but that's because all his other credit was very strong. And this was something he had done for someone else, and they accepted that explanation, and away we went with closing on the loan.
All right. And today's topic,
right?
As the slide tell us down there.
Yep, credit score, what it is and what it doesn't show. Income and employment, how important that is, debt and monthly applications, or you might hear us say DTI, that's debt versus income. The ratios are pretty important. What's your savings and readiness? What are some common myths? And we'll go into a few questions and answers. So that's what we're going to talk about today on today's podcast.
All right. For those of you who are perpetuating yourselves in tendency, working back to back, all of the shifts your employer have, and then putting the money into the bank account, funding your landlord's retirement program. I mean, help me understand. So let's go to slide 3 now. I think we're there, right? Credit
score. We're there. So we do look at credit score, and that's a strong indicator. But so is your income. How long have you been at your employer? Did you just change jobs? Do you have gaps of employment? Like, do I work for 4 months and then I take off 2 months, and then I work for 6 months and I take off a month or 2 or 3, and then I go back to work? That's not stability that's happening. They're looking for somebody who's stable, who's working that job. If they're hired for 40 hours a week, that they're really working 40 hours a week, or if they're hired for 38, that they're really working 38. So they're looking at the income and how dependable you are in going to work in order to bring that income home, because we depend upon you going to work and bringing that income home in order to make the mortgage payment. So income and dependability and stability is so vital in the whole process of buying a home. And then we look at your debt. What do you have out there for debt? Do you have maybe a JCPenney credit card at $50, or do you have a Citibank credit card that's at $10,000 and you've used $10,000? How do you handle credit? Are you able to pay it off on a monthly basis or over 2 or 3 months? Or are you years out from being able to pay off your credit debt? And that just continues to accumulates and gets tougher and tougher to do. Then how do you buy a car? If I've got 3 credit cards and I'm paying $450 a month for credit cards, but I don't have a car payment, now I bring your car payment into that, boy, I might not be able to make those credit card payments. So I might start defaulting on those because I have my car, because I need to go back and forth to work. So how do you manage your debt? Are you able to spend appropriately for your income level? And are you able to handle the paying off? If I buy a TV today and I need to pay it off over 3 months, that's fine. But if I need to take 3 years to pay off a television set, maybe the television set was too big or out of my price range. Maybe there's something else that was there that maybe I spent over beyond what my debt versus income ratio should be. And then we look at savings. Savings is so very important. If you don't have a savings account set up where you're putting $25 a month away, you are hurting yourself dramatically. One of the things that I really recommend is that if I'm paying $1,600 a month for rent, but my house payment looks like it might be $2,200 a month, I really would like people to figure out, okay, so let's put that $600 a month difference away into a savings account for the next 4 months as you're getting ready. Can you really do that? Can you really make that mortgage payment then, in theory, by putting the difference into savings? And 4 months of $400 a month or $600 a month, 4 is 16, $2,400. It starts to really add up. So instead of spending that money on, I don't know, I'm not trying to pick on anything. Instead of going to the coffee house every morning or going out to eat, if I go out to eat, it's $10 if I'm lucky. And I do that once a day because I maybe do it at lunch or I maybe do it at supper. And now I'm spending, $100 in 10 days, $200 a month. And I think to myself, well, I deserve that. And the answer is yes, you do. But what if you took that $200 and put it into savings, and now you're able to buy a house because you can come up with that down payment? So what can I give up? What can I not sacrifice? What can I do this instead of that, right? Can I put it into savings instead of buying a cup of coffee? Can I put it into savings instead of buying lunch today? If I do this instead of that, and trying to make those decisions financially as you go along, this versus that, will help you start deciding to save. And it's like, some days it's like, this is a Dairy Queen that I'm out here with my friends with, and I am getting a blizzard no matter what. That's a this versus that, putting that $10 into savings. And those are choices that you make. But you make the choices. You don't let the money lead you. You start taking control and leading your money. And that's what's really important, to show that you have control over your money rather than your money having control over you. You're not trying to chase it, or to put it on a credit card because I don't have enough income for the rest of my month. So I'm putting it on a credit card, what's ever left over for my spending habit. Instead, I am paying everything off on a monthly basis, and that's what they're looking for, is those kind of things to help you become a more, as you become a homeowner, things are easier for those that take the time to pay things off or be in control of their money versus letting their money be in control of them. Does that make sense, William?
Definitely, and that is what they say. If you don't have a plan or budget for your money, I mean, it evaporates.
Right? Spending plan. I call them spending plans. It's not a budget, spending plan. And I like to, in my spending plan, I have $50 a week that I don't have to account for, that I get to spend any way I want to. So my $50 can go for, maybe I want to take some friends out and we go out to eat, or I just want to go and pick up snacks for a little party or whatever it is. I don't have to account to my husband for that $50. I can spend it any way that I want to. I can buy him a gift. Maybe it's that time of year, whatever. But we have so much per pay period that we can spend, and we call it the no questions asked money. And that really has helped us to be able to, like, if I want to buy something and it's $200 and I get this $50 a week, maybe I'll take 6 weeks and I'll figure out how to save up that $200. So now I can buy this $200 item with no questions asked, right? Because I've got the money and I've saved it through our system. Just seems to work itself out.
All right, all right. For those of you who are perpetuating your sales in tenancy, help us understand, but let's go on to what? Slide 4, income and employment.
Right? Consistency matters more than perfection, right? Job changes can be okay, but once you start doing multiple jobs, Fannie Mae just came out with a document that says multiple job changes in the same industry are not considered acceptable anymore if there's greater than a 30-day gap. So then you have to start the time all over again. So you'd have to be in your job 6 months to show that you have the longevity and the stability again. They were finding too many people were jumping jobs. Like, again, they'd be in a job for 4 months and then they'd be off for 60 days. And then they'd be in a job for another 4 months and they'd be off for 60 days. And that used to be an acceptable situation, but they found that that just doesn't create the stability that they're looking for someone who's becoming a home buyer. They need someone who's going to consistently be making that and earning that income so that they're not chasing that job, chasing that income. So multiple jobs, again, cause multiple jobs in a time period. If something's been over 30 days between jobs, we just have to take a look again to see how long you've been at your current position before we can use that income again. And do you receive hourly income? Do you receive bonus? Do you have a second job income that may count when it's consistent, right? A bonus or a second job or commission, something extra and over the hourly, 2 years. It requires 2 years history to be able to use it. Now, I might have a second job, but that second job, I just changed from ABC Home Health Care to BCD Home Health Care, right? I was working 26 hours there. I'm working 26 hours here. There's been no gap of greater than 30 days. I was making $18 an hour there. I'm making $18.75 here. That's an acceptable, consistent basis, right? But if I was working for 6 months again at that part-time employment, and then I changed jobs, but there was greater than a 30-day gap, the whole cycle of the whole 2 years starts over again on that second job. So it's very important that you're working with a loan officer and staying consistently employed. Minnesota example, we do have seasonal work here in Minnesota that you can qualify with a 2-year history. I might work from, there's school people, right? They work from the end of August until the beginning of June, end of May. Then they have off June, July, and August. So then we have a 2-year cycle that you must go through, be back employed or be employed by the time the first mortgage payment is done. We've got a letter from the employer that says, yes, you're coming back. And so then we can use that because we've got that 2-year history to show that you have the pattern of that seasonal work. But consistency matters more than perfection. Job changes can be okay, but we need to document and explain what happened. Hourly income or salary income, the base income is very easy, but if I'm hourly and I tell you you tell me you work 40 hours a week, but I calculate out and it's like, maybe you're only working 38. And we all love, all right, now I'm supposed to work till 4:30, but there's nothing left to do. It's like, I'm going to just check out. So a lot of people tell us that they check out and then they go sit in their car for that extra 15, 20-minute me time that they haven't been able to have for a while, right? So they go in and get that me time. Maybe they do some social media and then they head home. And they don't, in their mind, understand that they're really only working 38 hours a week. They're not working the full 40. So if you're hired for 40 hours a week, you really have to consistently work 40 hours a week in order for us to use that full income. Some people are paid every other week. That's 26 times a year. And then some people are paid twice a month, and that's 24 times a year. So we have to look at those things. That's why we're asking for 3 to 5 pay stubs in order to know what your consistency is, so we get a feel for that. If in the last three to 5 pay periods, you show me a 38, a 36, a 42, a 41, I have to average that. I can't use all of that income because you showed me a 36, but maybe it was a 36 with 4 hours paid time off or 4 hours unpaid time off, and that's calculated in there somehow. Then that's a difference. Maybe my mom passed away or maybe my mom got sick and I needed to take some time off. Well, then that's understandable why that 4 hours was short. And we have the other 2. I just had one customer. She makes $1,600 minimum per pay period. And that's what we use to qualify her at. But sometimes she would make $1,602. Sometimes she'd make $1,856. But we went in knowing that she made on each pay stub no less than $1,600. So that's what we claimed for income. This is her minimum income, $1,600 a pay period. And we were able to prove that because actually what she did is she went and got me all the pay stubs for her income for last year. So we could look through it and go, okay, you really are trying to work the 40 hours a week. I see that, but 38 is more on average. But I can see you always get 1,600. 1,600 makes the loan work. Let's go with that figure. And then the underwriter will underwrite it under that $1,600 rather than at some obscure number that I'm trying to reach that you don't work those many hours, a week. So income and employment, it really takes more information. Some people say, well, send me a pay stub or how much do you make an hour? And then they calculate your income. That really will harm you if we're not asking for more than that. Some people go, well, how come you need all this stuff and my other guy didn't or whatever? And it's like, you want to be sure that when I'm writing that pre-approval letter, that you're going to make it all the way through the house, and that all of a sudden my underwriter's not going to say, well, the income isn't what you said it was. Where's the proof? And when we show the proof, it can't substantiate what we've said. So that's what we're trying to do, is always look for the documents to substantiate what we're saying so that we can confidently go in on a pre-approval.
So again, the key word is what?
Right?
Yep, and the key word is what? Consistency. Let us look at what? Slide 5. Understanding, this big word here, this economic word here, debt to income, DTI.
Right. So our monthly income, let's say, is $1,000, right? $300 of that is going to go towards my monthly debt payments. That might go towards my credit card, my car loan, my student loan, etc. And people say, well, then that leaves me 70% for income for housing and for living. And the answer is kind of, right? But what we tend to do is the first 25%, the first $250 out of $1,000 is going for my federal income tax, state income tax, maybe health care, etc. And that's really leaving me with 75%, right? So then I've got 75%, and if my housing ratio and my debts come up to 45%, right? So my house payments and my car loan and my credit card debt, and my student loans is 45% of my income. That leaves me 30%. So 45% of my income is for the payments that I have to make on paper. but 30% of my income, or $300, is what's left over for gas, groceries, car insurance, maybe daycare, right? What is it? Do I have to have pet insurance? Do I have a dog that I'm also feeding? What that 30% that's left over is for life. So 45% is for your housing and student loans, car loans, credit card debt, etc. 30% is for life. Not, I just am not, people look at this as a two-tier system, a 75 or 70 and 30. You really have to look at it as a three-tier system. 25% gets pulled off because that's what they're going to be using in order to pay your state tax, federal tax, maybe insurance for health care, Social Security tax, etc. That's where the first 25% comes. Then 45% again is for your car payment, for your house payment, for your credit card debts, for your student loans. That's your payments, your monthly payments. And 30% is what's left over for life, right? That's gas in the car, that's groceries, that's my utility bills, that's goodness gracious, it could be just about anything. I need to get an oil change. I need to get new tires. I need to get a haircut. I need to go get a manicure or a pedicure. I mean, I need to go have life, right? And that's what that 30% goes for. And if we get this housing ratio and your monthly payment debt up too far, that just a lot. Sometimes I see this number become the housing ratio and the payments like 70% of your debt or your income is used for housing payments and payments. That leaves you nothing. That leaves you 5% for gas, groceries, car insurance. I mean, haircuts. It's not enough. You need to really be more balanced in what you do. So 25% goes for out of your check right at the very beginning. 30% is going to go for your lifestyle, and 45% is going to go for your debt. So you just really want to keep that debt in control, not overspend. We don't want to put you into a $500,000 house when you really should be in a $325,000 house. We want to keep that debt versus income ratio appropriate so that you have success in life and you're not swimming and drowning actually in debt. We don't need you to be drowning in debt. So that's understanding the debt versus income ratio. And again, real income, right? So maybe I'm hired for 40 hours a week, but I usually only work 38. So it's debt versus the real income numbers and the consistent income numbers, not the extra. And for me, I'm not one that likes to include bonuses or overtime in those ratios, because when I get a big bonus, I usually am spending that a different way. If I get a bonus, it's like, woohoo! I can put a garage door opener and garage door on my garage, or I can buy that new couch. Or we spend our bonuses differently than having to include that in our ratios. And I have some people that have been at a different lender that says, okay, well, you're going to get a tax return and you're going to get a tax refund back, and it looks like you're going to probably get a 10% refund back. So let's calculate that back into your house. And it's like, wait a minute, when I file my taxes and I get some money back, again, I spend that differently. I don't say, oh, well, they calculated my house payment based upon my refund. So I've got to put my refund into the checking account so that I have 1/12 of that each and every month so I can contribute to my house payment. Are you kidding me? I get that refund back, and that's what I do for my vacation, or maybe I need to put down payment on a car, or I need to really get my car fixed. We spend those kind of things differently. So we have to really make your debt versus your basic standard income ratio work so that you can live life as well, right? So again, consistent income is what we're looking at.
So it's not just what your credit score is. I mean, it's also what does your monthly debt situation looks like. I mean, it sounds a bit technical, but what I realize is that the big takeaway is simple. Lenders may also want to understand how monthly debts work. fits with monthly income. Let us talk about what savings and asset.
Right? So we're on to savings and assets. Preparedness matters, not wealth, right? I don't have to have somebody that has $20,000 in order to buy a home, but you have to have a couple of $1,000 put in the bank. You have to have $1,000 in the bank at least for some programs. Our Old National Bank program is $500, but $1,000 on average that you have to have access to. But really, if I'm using all of your money in order to buy a house, that leaves you nothing. Nothing. All of a sudden, you need to buy a snow blower, or you need to buy a shovel, or you need to buy I don't know, a lawnmower. You need to buy things for the house. If you don't have some money left in savings after you close on the loan, those things will all go on a credit card and cause you disarray. So it's much better to have a little bit of money in a savings account so that you, when it comes time to you buying your house and you're in, that you're not supplementing that purchase by putting things on credit. There are plenty of low down payment programs that exist, but reserves help reduce the stress. Gift funds may be allowed with documentation. Gift funds are pretty common. Your seller can gift you. Your parents can gift you. Maybe we're getting a gift from Old National Bank in Hennepin and Ramsey County. We're doing 3% of the purchase price as a gift. There's some income restrictions there, but they're pretty generous. And in Minnesota, the assisted grant programs be available. There is the Minnesota Housing Down Payment Assistance Program, and that's a marvelous program in order to participate in. I have a customer today that they're making an offer based upon using the Minnesota Housing Program. They're buying in Dakota County. There was a down payment assistance program that became available. I think it was probably May 20th, and that one's already gone. So there's a lot of them that come and go. There's some that are consistent in there. For instance, the state of Minnesota down payment assistance, $14,000 with their program. That does not run out of money anymore. And Old National Bank, they're 3% of the purchase price. That's a gift or a grant, and that isn't going to run out of money either. And that's for Hennepin and Ramsey County, though, exclusively. So having your savings, put that $25 a month away. See how that works for you. Up it to $50, up it to $75. If I'm paying $1,600 for rent and I think my house payment's going to be $2,200, can I put $600 a month into a savings account and make it grow, right? That's what I want to try and do is try and make those things work so that I can be part of the whole process rather than all of a sudden being hit like, oh, we're in the house now. We need new shades. We need this. We need that. We need to try and get you so that you also have a savings program set up so you can afford those things after you're done at the closing table.
All right. Because what a lot of people hear savings and think, oh no, I need to be rich. But it's all about what? Preparedness. Preparedness matter, not
right?
wealth.
Right? Don't have to have that 20% down. Don't even have to have the 3% down. There's programs out there that'll help you with that 3%. Don't have to have the 3% for the closing costs. There's programs out there that'll help you with that. But you do have to have something. You have to have some sort of skin in the game in order to make that purchase happen. And afterwards, as you start to buy the appliances that you need, maybe it's a lawnmower again, lawnmower, snowblower, shovel, whatever it is that you need for your yard, those things start to add up, and they add up quickly. And putting them on a credit card, because that's the easiest way. You know, and I think I'll probably pay that off next week or when I get paid, and then something else comes up. It's too much of a vicious cycle that keeps you in debt. And we really want you to buy a house to help you build wealth, not to minimize you and keep you in debt as well.
All right. For those of you who are perpetuating yourselves in tenancy, just working back to back, just collecting all the shifts that your employer can offer, and then take that money and dump it, fund your landlord's retirement program.
right?
Help me understand, because I mean that is what renting is. Just funding what your landlord's retirement program, keeping you working longer and retiring them early. So help me understand this 2026. I mean, what is stopping you from financially forward thinking and perpetuating yourselves in tenancy for simplicity's sake, keeping yourselves in tenancy where you don't own a roof. You own nothing. So let's look at what slide 5. Okay.
Five, we're talking about what progress could look like with 12 months, right? So,
Exactly.
moving on. So, what we've
There
got,
we
so
go.
let's say I've got $600 a month and I'm putting it away. That's the difference between my rent and what my mortgage payment estimate will be. So, that's $600 a month. In 10 months, that's $6,000, right? In 5 months, that's $3,000. That's a lot of money. That's probably more than what most people have saved in the last couple of years. But if they concentrate on that money and say, okay, this is what my house payment's going to be. It's going to be $600 more than what my rent is. So let me put that away in practice, right? 10 months, that's $6,000. That's a lot. That's a lot. So if it takes $1,500 in order to buy the house, $2,500 in order to buy the house, now I still have $4,000 left over, or $5,000 or $6,000 left over in order to be able to buy those things that are necessary for the house. Maybe I need a new bed, maybe I need a new lawnmower, whatever it is that I need. I now have the financial wherewithal to do those things and not end up putting it on a credit card. So being prepared is what's most important. We'll go on to the next one, if you don't mind, William, because you're just doing a great job here being my flipper, and I really appreciate it. The common myths and the truths, right? I need a perfect credit. The truth is patterns and overall profile matter, right? So again, I recently did someone who had a foreclosure on a mobile home that his mother, he had signed for his mother to buy. That one had been 3.5 years since that foreclosure took place. And we still are able to do that. And I didn't have to count that payment into the debt to income ratio, nor did we have to pay it back, because his other credits spoke volumes for him that he pays everything else on time. That just was something weird that was out there, right? I need 20% down is the next myth that we hear all the time. Low down payment options exist, 3% down, 0 down rural housing, 0 down VA. But, even with 3% down, you go, well, gosh, on a $300,000 house, that's $9,000. I don't have $9,000. That's all right. We've got Minnesota Housing that's got $14,000 that they're going to give you as a second mortgage down payment assistance. We have Old National Bank that's going to give you 3% on a $300,000 home. That's $9,000. And so now all of a sudden you got that 14 and that 9. Well, that's $23,000. That's more than you need in order to get into the house. And in that particular loan program, you only need $1,000 of your own money into the transaction in order to make it work. So maybe we put a little bit more down, or we don't quite borrow as much on that second mortgage, but it gets you into the house for minimal money. Another myth that we see all the time is only salaried jobs qualify. The answer is that all jobs qualify. It's, are they consistent? And where is their consistency? What's that line of consistency? How do we take what you're earning and show a pattern? How do we take what you're earning and show a story? Like I said with the past customer, we were able to show the story that she made $1,600 minimum each and every paycheck, so that we were able to use that to qualify her. Now, at first she told me she worked 40 hours a week, but once we pulled in the 5 pay stubs, we went, oh, there's something that's a little bit off here. So instead we went back and said, okay, minimum $1,600 a pay stub, $3,200 a month. That's what we're going to use. And that's what we were able to use in order to get her qualified. So we find out what's consistent, what is something that's dependable time over time, and that's what we'll use on the loan application. And people believe that one mistake ruins everything. I can't tell you how often people come in and say, well, I was late on my JCPenney card 9 years ago. And it's like, yeah, I don't care. And then they'll say, well, the last guy just told me that that's why my interest rate's going to be 7.5% instead of 6.25%. And it's like, He's 7.5% because he knows you have a weakness, right? You have something there that you feel bad about. And like me, I don't care. It's over 2 years old. I don't even probably care if it's over a year old, right? Don't care. Don't care. Not going to make any difference on your interest rate. It's how consistent are you? You've had that one blip or that two blips is not going to really destroy you. It's pay your bills on time, pay as much as you can on your credit cards, pay more than the minimum payment, and you will watch your credit score raise, and you will see yourself become a credit, I call it a credit giant, someone who has taken control of their credit rather than letting their credit take control of them. So one mistake does not ruin everything. Time and consistency make all the difference in the world.
All right. Help me understand, Cynthia. I'm not mindful of the fact that this slide did say that seasonal job counts, right? But then how does seasonal job translate to consistency?
Single job, did you say?
Seasonal.
So consistency is 2 years. So if I do it for 2 years, I show that I worked, was laid off, and maybe I have unemployment during that time, right? I can use that unemployment because I'm going to work. I'm going to get the unemployment again. So now I've been through 2 seasons, 2 cycles, right? Now I show that that's consistent. I'm back to working again, and I can now use the seasonal income, and I can use the unemployment that I received during those time periods in order to qualify for a mortgage. So seasonal does not count you out, right? The one thing that counts you out or becomes a little bit harder to overcome is multiple jobs, leaving one place, going to the next, leaving the next place, going to the next. If I'm doing it because I'm increasing in income and increasing in job opportunities, and I don't have breaks in income, I go from one job to the next, that's a different look than than if I work for 4 months and I take 2 months off, and then I work for another 3 months, and then I take another 3 months off. That's not being consistent. There's no consistency to my income coming in the household. So being consistent is very important. Income being consistent.
All right. The gentle next step.
The gentle next step is pulling your credit report and looking for surprises. Errors do happen. There can be stuff out there. And then we'll look at the monthly payments, your car loans, your student loans, and your credit cards. You're going to pick a realistic monthly savings target. If it's $200 a month, let's pick it and start it. And if you want, I'll get a personalized plan for your comfort level and timeline. So do you want to buy a house in 60 days? Well, here's what you need to do in the next 60 days with your credit in order to do that. Are you going to buy a house in 9 months? Okay, 9 months. So let's see what we can do in 7 months from what's going on with your credit. So that's what we'll do. It's just a real gentle next step. Every situation is unique, but let's pull your credit report, look for surprises or errors, list the monthly payments, find that versus your income, debt versus income ratio. Pick a realistic monthly target, savings target, and I'm happy if you do $25 a month. I think that momentum will start you moving forward. Is that even that little $25 a month gets you a couple $100 a year, and then we'll get you a personalized plan for your comfort level and timeline in order to put yourself together.
All right. For those of you who are perpetuating yourselves in tenancy, just making those, and you call it not generous not generous contributions, but I mean, help me understand. Questions, Emmanuel. I see we have Emmanuel here. Cynthia, this is Emmanuel, an associate of Keller Williams.
Emmanuel. Hi, Emmanuel. Nice to meet you.
How are you doing today?
Good. Glad you were able to join us.
I'm glad I'm here. I'm learning so much. Even me as a real estate agent, they think I'm supposed to know everything, but no, here I am, listening to this amazing program and this broadcast. So yeah, I appreciate Mr. Williams for hosting this. I appreciate coming through.
Right? He brings a lot of people in who need this information. Just absolutely great outreach that he has. I'm just so grateful that he's here to help people become homeowners, here to help people start building wealth. That's where this comes from. He and I both, you can ask us anything. There's no pressure. We're not going to pressure you. We're just going to help give you your answers so that you can move on. If you're not ready today, we'll help you with a simple plan. And we focus on understanding your numbers and your timeline. Neither one of us are ready to push you into buying a home tomorrow if you're not ready to buy until October or November. But we are here to help you become ready so that when October comes, you really can get the best interest rate, best loan program available for you. And Emmanuel, if you're a realtor, is that what you said? Yes, realtor?
Yes, ma'am.
Yep. I'd love to meet with you to just share a couple of the programs that we have available that might be of benefit to your customers.
That would be a blessing. That would be a huge blessing to me and my business. And if I do have a couple of questions, I won't be shy to ask away. This is the part for questions, huh?
You're a little bit hard to understand because you've got some breaking up that's happening. I don't know, William, is he breaking up on your side too a little bit?
Yeah, definitely. Yeah, breaking up. I don't know what is happening down there. Yeah, having a lot of breakups.
Try it now, Emmanuel. Do you have a question for us?
Go ahead, ask your question with no pressure, Emmanuel. Can you hear us?
Hello, can you guys hear me?
it's terrible. Your sound wave is terrible.
Well, I'll tell you what, I'll get a hold of you after and we'll set up time for lunch. Maybe we can get William to go to lunch with us and we'll sit down and talk and do those things. And maybe we can get you on the next webinar here that we do because we'll be back again next Monday.
All right. So today we talked through the presentation page by page. And the main message is clear. A credit score matters, but it is not the only things lender may look at.
Right.
So thank you so much for joining us today, Cynthia. I mean, we cannot underestimate the appreciation that we have, for taking up your time off your busy schedule.
Thank you so much, William. You have a great day, Emmanuel. Nice to meet you. I look forward to connecting with you soon.
And thanks to everyone for listening. We hope this made the topic feel little clearer and a little less scary. And so until we do meet in another episode, I want you all to help me understand, what is stopping you from financially forward thinking.
We were supposed to buy from Bill. However,
once it's working with him,
yes, he did a good job, and everything went very well. And so he very focused pricing. And I will ask that anyone that wants to buy a house, he will be one of the best realtor to work with. Thank you.
All right. For those of you who are perpetuating your sales in tenancy, just making a generous contribution on a monthly basis. I mean, help me understand this 2026. What is stopping you from financially forward thinking? Talk to you soon.
Red one.
Yeah?
Hey.
I
can't do that.
For all the do work, you pour all two of the things in the bag.
Yeah. I already took it down.
All two?
Yay. Hi.
Dinner. All two of the sun in the bag?
Yeah. Yeah. So how was your experience today?
Amazing.
Well, bye-bye. Say bye.
Very, very amazing. I'm so proud of him, This brings tears to my eye for the kind of work he has done in a short period of time.
Guys, can I show you something about preaching? I'll just take you to this main stadium. Here's the microphone. Hold up, we're about to blast the whole stadium right now.
I don't think this is a stadium, but
You ready?
we're in class right now, totally.
So, guys, today we have a birthday today. So, grab your presents and something.
But you're not showing yourself. You're taking video. You're not showing yourself.
Oh yeah. And
You're not gonna grab it, baby.
and then we're gonna celebrate. Happy birthday to you. Happy birthday to you. Happy birthday. Happy birthday. Happy birthday to you.
Hi.
Girl, you're not even saying anything. Happy birthday to you.
Okay, we need to put the mic down.
Mwah.
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 Okay, it's mute. My arms hurt.
Give me the camera.
Yeah.
Okay, so
My arms hurt.
oh wait, it's green. Whoa. No, you didn't. Let's go. Let's go. Daddy, say bye.
Thank you very much.
Say bye.
I appreciate it.
Daddy.
You'll see more.
And it would be glad to.
Yeah, bye to you all.
Bye.
Get in the car. Go on.
Oh.
Bye, bye, bye.
Bye.
Whether it's your first home or move up.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Stuck in comfort, stuck in fear. That's why I'm staying here. If the pipe begins to leak, I don't even have to speak. But who pays for it really? But that comfort as a cost. Not the equity I lost. While I sit here paying rent, my future cash is already spent. Some days fast, some days slow. That's just how the tenants go. But if you listen to the sound, it's your money. Don't let it hit the ground, Kobe.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Helping them in investment grow. They go turn, wrapped up in a be so firm. They go turn, letting know my money burn. You pay a mortgage every month. It's a fact, it isn't blunt. The only question left to
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
It's the future that you lose. Every check that I have sent vanished in the void of rent. Stop the vanishing out. Yeah. Void thinking, that's the key to break the chain of tendency. Stop the trend of resupply. It is time for me to buy. Let's turn. How I make the
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Yeah. Don't perpetuate yourself in Tennessee. Take the move. William Karpeh. Helping you buy, sell, and invest with confidence. Pick up the phone, let's change the path. Call or text me. 1651-33044.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Let's make it simple.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
First, let me ask you. Help me understand.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Watch the numbers running out. Send the check to someone new.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future. Every month you send a check. You call it rent. I call it a generous contribution to someone else's future. Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
First, let me ask you. Help me understand what is stopping you from financially forward thinking. Let's go. Yeah. Wake up, check the bank account. Watch the numbers running out. Send the check to someone new. Generous is what I do. Walking down the leasing street. Cycle that I just repeat. Money rushing left and right. Gone before the end of night. Don't know the route, don't know the.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
It's impressively rap, but it's still a trap. Forward thinking, not today. Tendency is to stay. Generous contributions flow. Helping that investment grow. They gon' turn, they gon' turn, they gon' turn. Wrapped up in the police so firm. They gon' turn, they gon' turn, they gon' turn. Letting all my money burn. Hold up, pause the beat. You're making that generous monthly contribution, but are you building your legacy? Whether it's your first home or move up.
Every month you send a check. You call it rent. I call it a generous contribution to someone else's future.
Stuck in comfort, stuck in fear. That's why I'm staying here. If the pipe begins to leak, I don't even have to speak. But who pays for it really? But that comfort as a cost. Not the equity I lost. While I sit here paying rent, my future cash is already spent. Some days